Maybe like summer. All right, man. Finally ready.
We're good. We're all ready.
Yeah.
All right. Well, I had chapter 20, which is payroll. Not very exciting, but we'll get through it.
More fun when you're auditing it.
Yeah. So when I look at these chapters, I think it's really important to first understand the cycle, because if you don't know the cycle, then you can't really audit it. We kind of saw that on the test. If you didn't know the payment cycle, then you're probably in a little bit of trouble. So that's kind of how this chapter starts. The overall audit objective, as with every other section we've done so far, is to evaluate the account balances affected and determine if they're fairly stated. Nothing new there.
You'll write a conclusion to that effect too. The area of the audit.
This is your standard. I think these are really confusing, so if you're a visual person, it shows how all the balances are intertwined.
That's just all the debits and credits to all the accounts, right? Payroll and personnel. It's like any other area.
Nothing new. In most systems, the accrued wages and salaries account is used only at the end of the accounting period. I'm guessing that just means a end-year adjustment, or
yeah, they don't bother with adjustments during the year because they're typically pretty immaterial. If they're material on a monthly basis, you do it, right? Or on a quarterly basis, you do it. But otherwise, well, it says end of the accounting period. I lied. So they are doing it monthly or quarterly. If you want to be accurate, you would. It still is immaterial, but they don't mess with it otherwise.
So the payroll cycle is really focused around the HR department. It kind of begins with the hiring of everyone. Everyone's filled out that long packet of paperwork.
What's the big segregation of duties thing here? What two areas do you need to keep separate?
Payment.
Payroll and personnel need to be completely separate, you guys. The people who do the hiring do not decide how much they make. That's the person maybe that they're working for. They don't supervise them, right? They don't write the paychecks. In fact, what about deciding the pay scale? That's authorization, right? What about hiring a person? That's an authorization thing, right? Interviewing personnel would do that. You know, so you separate all this stuff, right? And then you separate the, I guess you could say custody is the one word for it, if you want, right? Okay, but running. And then you're going to separate the record keeping and separate the cash disbursement to them, right, guys? It's the same thing. Different.
It starts with the hiring and ends with payment. We just said separate those two out. So some of the forms that are important to know. The HR records is just everything you fill out when you get hired. I don't know what specifically is in there. I'm sure everyone's filled out all those forms. Deduction authorization form that allows for payroll deductions. So that's authorized. Rate authorization is just a manager or someone authorizes the rate of pay.
So all that, if you look at table 20-1, all that's there, right? There's human resources employment. Has those documents. Gets those documents, has those documents.
So the second part of the cycle is timekeeping and payroll prep. Just some of the, I guess, documents that are frequently in this section are the time card, your hourly, clocking in, clocking out. Usually what we'll be doing will be salaried, but
Used to be on a machine, now it's on a computer, right? And you just log in and log out of your computer, and you're logging in and logging out. Correct.
next you have a job time ticket, which indicates the job an employee worked on for a period. I kind of just think of that if you're on a client. Say you're on Atria 1 week or another client a different week. Those are two different job time cards. Payroll transaction file includes all payroll transactions for a period. And payroll journal is generated from the payroll transaction file, includes employee's name, date, gross, net pay, pretty much everything they got paid, all their deductions. And then finally, the payroll master file reports all payroll transactions for an employee and maintains.
And all this stuff is record keeping right here.
Yeah.
Might not all be being done by the accounting folks, but certainly the time record with time. Maybe not the job time, but it would be. It's all clerical. That's it. Yeah.
just went over this payroll master file.
You know what these things
Yeah,
are.
I'm not really sure what they were trying to get at right there.
That's payment, that's being done, that's cash disbursements function, it needs to be separate, right guys? Doing the payroll check, authorization of it, control of it, same thing as with writing a check for accounts payable, right? All the same controls, okay, and we're doing a back reconciliation here too, so controlling cash, of course.
Yeah,
Usually an impressed account, payroll, right? So you could write a check, you guys know what impressed is, right? Keep a balance in there, if an employee quits during the month, you could write them a check. So you can hand it to them the day you fire them, or the day they quit, so they go away, right? Because they're probably not happy with you either way, right? And then at the end of the month, when you do your payroll, or whenever you do your payroll, you replenish the impressed account, and of course, put in it up to the current payroll, right? So you always keep some money in there, a few $1,000.
Yeah, just elaborate. It's just separate bank account for payroll transactions. Helps limit exposure to payroll fraud.
Also, you have different controls, right? You might have a limit on how big the paychecks can be, as in you can't pay somebody $100 million paycheck, that kind of thing, or $10 million paycheck. The computer will automatically make sure that paychecks are within a reasonable range. Right?
So the last step is the preparation of the payroll tax returns and the payment of taxes. W-2 is the form you receive every year for your tax purposes. Each employee gets one of those. Payroll tax return. Not really sure how that.
Well, the tax returns for your 941s, reporting taxes, Social Security withheld, federal income tax withheld to the federal government. You're going to deposit those, right? Remember those journal entries to record that you debit wage expense for the full amount of the wages, right, guys? And then you debit payroll tax expense or something for the employer's share of the Social Security and the other employee taxes that you're paying, right, that the employer pays. And then you credit wages payable to the full amount, right? Okay, well, wages payable for cash that you're going to give them. And you credit FICA tax payable and FICA and withholding payable, those types of accounts, right, for the amount that you owe the government. And then these returns are telling, the W-2 is telling the employee how much they made, and telling the IRS how much they made, right? So that they can be taxed on it, and how much tax they paid. And then the insurance is telling the government, right, quarterly, what it all is, okay, or more often. Okay, so you'll see these things.
Next is understanding internal control. Exact same slide, same cycle after cycle. Just some of the key controls. How does it go? It doesn't go through it, but I'll walk through it. Adequate separation of duties. I kind of mentioned this. Payroll processing should be independent of the HR department. Proper authorization. Example would be supervisors should authorize hours, make sure there's nothing unreasonable. They should also approve overtime. For adequate documents, records. Anything in particular for that? I couldn't think of anything.
Well, the documents you were talking about earlier, they should all be there. It can't be done without having the time recorded and come back. Those sorts of things. Okay, proper authorizations. Authorizations just on pay scales, right? And raises. That's a hiring first. Sure.
Physical control over assets. The one I noted was payroll checks that should be properly controlled, so you can't just go write a check for somebody for an unauthorized amount. Independent checks. Independent employees should review output for any obvious mistakes. If anyone's written a $100 million check or anything, somebody could detect that if you.
Well, and you talk about doing a back reconciliation. That's an independent check, right? What's going on? Sure. Okay. And then if you add up all the W-2s, it has the total payroll. If you add up all the quarterly reports, right, to the government, it has to add up to the total payroll. So you can tie all this stuff together, right? And somebody should be doing it inside the company as part of their internal.
Payroll tax reform or tax forms. You should understand those are part of internal control, and you should walk through it, or not, I guess it wouldn't be a walkthrough, but watch and prepare one of each form just to make sure they're doing it right.
What kind of the audit procedure is that? You watch them do something? Well, a walkthrough, but that's for obtaining understanding of the internal control.
Yeah.
And And also it does audit one time through the controls, right? That's controls. But what else do you want to do? When you're observing them, what are you doing? It's an observation. I'm observing them, it's observing, yeah. Okay, so it's as simple as that. I can watch them do it, and that's developing an understanding of the internal control, but also testing the controls, isn't it? Yeah. One.
And then timely payment, you just want to make sure that they're paying on time.
Yeah, if you don't deposit on time, you get penalties. By the way, it's your employee's money, not yours. If you ever start a small business and decide you can't afford to pay payroll, you are considered to have stolen the pay from your employees. And if you decide not to send their money into the federal government, they'll decide that you stole that money too, and you get to go to jail, right? So there's fines for being late. It's not your money; it's theirs. Okay, so if you get in a credit crunch, who do you not pay? Hopefully, you pay everybody, right? But if you have to not pay people, who is it? Open accounts, well, yourself first, yeah, and then open your stockholders and so on, and then open accounts payable, interest on debt, things like that. You call them and say, hey, I can't pay you. Don't do that with your employees. Pay your employees, and don't do that with the government. Obviously.
Another big thing in this chapter was the relationship between payroll and inventory, which I'm sure Grant will kind of go on in the next chapter. As he parks up over there. If it's a manufacturing company, obviously direct labor is a big part of the cost. So direct labor affects your payroll. So that's how those two are related. When labor is a material part, you should emphasize the testing of internal controls over proper classification of labor to the product.
So compared, if you have 10,000 employees or 5, what are you going to rely on if you have 10,000? Internal controls. What are you going to do if you have 5? Some standard testing. Why would you test controls? Do it all. Not that you don't want to have good controls, right?
And then test for non-existent employees. There's several listed.
You know what? Direct deposit helps with this. If you have direct deposit, it's harder to set up a bookkeeping. You can still do it. If you're handing checks to people, though, you pretend the person exists and they don't. You go cash the check. So the supervisor turns in a time card, they gets a check, they can take the check and cash it or give it to a relative of theirs or something. So, yeah, so big employees.
There's a bunch of them listed on 659, but one of them I just noted was trace transactions from the payroll journal to the HR department, just to determine whether the employee actually exists.
Yeah.
And then they also have like a surprise check.
You know what? You can computerize that too. You can computerize it so that if there's not a personnel record in the human resource department, there can't be a paycheck run. And you can check instantaneously. So if somebody gets fired or they leave, right? Because what could happen is somebody gets fired or they leave, and then you keep drawing their paycheck, and the supervisor keeps getting the check and then not hand it to the employee. Right? Again, direct deposit's nice, right, guys? Because they obviously have to have a bank account where we go into, so it's harder to do it with a non-existent employee. But it's a nice way people pick to invest.
Okay, then now we're going to move on to analytical procedures and test analysis. These are all pretty much the same. Nothing new.
And after the way this last little test went, you guys will be able to do this next time, because what you've got, I'll have you do it again because it was useful. So you got to be able to do this, right? Can you list it?
Same thing.
All this stuff. Yeah, same thing, read it. Over and over.
All right, so analytical procedures, I'll just go over a few of the common ones.
Do you think you use analytic procedures here a lot?
Yeah.
It's the same deal, isn't it? Absolutely. Things on the income statement, analytic procedures are real nice anyway. And in this area, absolutely. Is payroll the same size? Is payroll expense the same size as last year, or is it reasonable that it's different? Is it same as budget, or is it reasonable that it's different? Right? And by the way, the accounts that are in the balance sheet relating to this stuff, how big are they? How big is salary expense and how big is salaries payable? Salary expense is massive. Salary payable is tiny. 1/12 if if you pay your entire payroll once a month, right? Certainly no bigger than 1/12. right? So, and should those relate to each other, by the way? What if you know the payroll is 12 times a year? What do you bet the accrued payroll is about 1/12 of the total salary? Do you think? If they're paying it on time. So what if it's only 1/20th? Right? It's under accrued. That's kind of an analytical procedure even for the balance sheet, isn't it? So, this is an area where analytical procedures are really handy.
One of the things I meant to mention earlier, we can test a lot of analytical procedures because the risk material in the statement is really low for this section. And earlier in the chapter, it lists a few reasons. Number one, employees will complain if underpaid. Obviously, what's the money they earn. Number two, all payroll transactions are uniform and uncomplicated. Usually it's about the same every month.
All computerized typically.
And then finally, payroll transactions are subject to audit by state and federal government, so you're taken a little bit more seriously. Coming back to the analytical procedures, a few common ones are to compare payroll with prior year, simple procedure. Or you can compare direct labor as a percent of sales, commissions as a percent of sales. A lot of these are using percent of sales to just to use an analytical procedure. And then a balance sheet account, compare accrued payroll with previous years and previous months.
Everybody knows what they're talking about when they say inventory, right? You manufacture, you do that. You manufacture what you do. Ford, building cars. Car goes out in the assembly line. The frame goes out in the assembly line. Yeah, but what? Work in process inventory, right? Right around materials inventory. And all the parts that go in, that's what you do, right? Just keeps going in, debit. What do you do with all the direct labor? Debit work in process, right? Credit salaries payable, wages payable, right, guys? What do you do with all the indirect labor? Debit manufacturing overhead, right? Credit salaries payable, or accrued payroll. True, guys? Okay, so it all accumulates in there. So and all the other overhead items. And then you take work in process in total, that big amount that you've got, and if you finish it, and the car rolls off the assembly line, what do? Debit finished goods inventory, credit work in process inventory. Everybody knows this, right? Just use it when you're auditing, that's all. Do you think, and then what happens when you sell it? Debit cost of goods sold, credit finished goods inventory, right? And of course, record the sale. Okay? Do you think in a manufacturing operation, payroll is a little bit more work than in merchandising? Oh man, it's a huge part of cost of goods sold in a manufacturing operation, depending on what their mix is of materials, labor, and overhead, right? Okay.
The last part is actually testing balances. Really, there's only two major concerns for this audit cycle. You got accuracy, which is the accruals and the trial balance are correctly stated, and then cut-off transactions are reported in the proper period.
You might have a few prepaids that you paid, but advances, that kind of thing. There could be a few current assets, typically.
I'm guessing these are just kind of sections that you could test if you wanted to.
Based on materiality.
All your accrueds.
A lot of these, accrued payroll taxes, I'm going to go get the 941 tax report, and I'm going to make sure that the number's the same. Right. As on the one that, for the next period, if it is right at the end of the year. Or you'll calculate what it should be. By the way, you could have pensions in this too, which could make things go crazy. You could add pensions to this, and that could be a big job item. So, then it depends if they have a defined benefit plan, particularly, right? Defined contribution resource. You guys know that, right? For 313, big difference there.
The only one in here that probably wouldn't use an analytical procedure is just check bonuses for reasonableness, maybe.
You could recalculate the bonuses if it's material. It might be easiest just to recalculate it.
On one job I was on, I did something with vacation. I don't know why they were concerned with it, but just recalculating.
Probably on a test basis. Did they have lots of employees?
No, tiny company. I don't know why they're just. I don't know. The person in charge didn't know what pay time off was, PTO.
The person in
I asked them about their PTO policy, and she didn't know what it was.
Oh, that's probably why you did it. They probably thought it was high risk. That's interesting, isn't it? That's a nice point. If you determine that the client doesn't know what you're talking about on something, right? And it's okay if they don't know the jargon, but they understand. It's like I told you guys that you might ask for a cash disbursements journal, and they'll tell you they don't have one. Well, of course they have one. You know, they call it something else, you know, a check register or something, and that's all they know. But it does lead you to think, well, they don't know where they record their cash disbursements. Their job is recording cash disbursements. It's a little weird. You know, so you get an idea of the level of training that the staff has with questions about. Even you say, what are these things? What do you have?
Yeah, that was one of my first jobs. I thought I was worried.
Uh-oh.
I didn't realize I would have to dumb it down, but that was like the only job I ever had on a test, my first one. Test the balances for expense accounts. A lot of these you won't have to do.
You know, you got a contract with your officers, right? They have an agreement. Pretty easy. Make sure they pay them what they're supposed to pay.
There are presentation and disclosure objectives, not as extensive as PPE, but as it says, complex transactions require disclosure.
Or long-term debt or leases or pensions. Or, I suppose you put pensions in this category. That's a big foot.
Yeah.
Monster.
Complicated balance. I don't even know what this is.
You know, a good thing you might do is take a financial statement for any major corporation and, you know, read through their audit reports at the beginning of the statement, which you know what they look like now, but go ahead and read through them. And then look at what their statements look like, balance sheet, income statement, cash flow, equity. And then it's all going to be familiar to you guys have done all this stuff. And then read their notes and look at what are they presenting in the notes. So what sort of disclosure is there? And that'll give you an idea. All of that had to be audited, right? If they write anything and they put it in the notes to financial statements, it's audited. So that's all part of the audit. So when you look at these areas, when they talk about what the disclosures are, you can get a really good sense of it by going through a company's financial statements to see what's there, right? What kind of things am I going to have to audit? And that'll give you maybe more of a real world feel if you have not been out working in a CPA firm yet. You know, if you haven't done any auditing in the field, or if you're one of those horrible tax people, you know, you haven't done any auditing in the field. So yeah, you're one of those. So that would be handy, I think.
Shows how everything relates again. I don't know, this doesn't really help me out. I don't know if it does anyone. It's a little too complicated looking.
Is there anybody else that really doesn't like all that visual nonsense? I just think, gosh. Give me some numbers. Yeah.
Anyways, that formula at the bottom said all of them. Same formula.
Yeah, sufficient, appropriate evidence. You have to go back to this a second. Somebody read off of those meeting to it. Put up the bottom. That's the controls. What's STOG? What's SOT? That's the transaction. What's AP? And PDD? Okay, and the point is always what? Where there are tons and tons of transactions and they are smaller, I am going to use what? Controls, reliance on controls. Right? If the account is immaterial, analytical procedures, right? Maybe the transactions too could be with the analytical procedures, of course. Where am I going to use to test the details of the balances? When the balance is material, right? So when you look at this one, you know, payments and expenses, what are we going to really rely upon? Test the controls, and then maybe test the transactions, and then maybe analytical procedures. It'll all work. And then what are we going to do from the ending balances? Probably analytical procedures. And if it's material, test the details of the balance, right? Or if we're concerned that it's recorded improperly, there's some risk. But you get the idea of the difference between the accounts based on how material they are, how complex they are. What's going to happen? The more material, what are you going to lean towards? Test the details of balances. That's it, right? The more risk that there could be something wrong. Test the details of balance, right? Less risk, less complex. Probably over on analytic procedures, and maybe even very little of that because you get the controls are really, really good, right? So you're fine. Okay. Anyway.
The only other thing I want to mention was the little excerpt on travel and entertainment entertainment expenses. It just covers that that's one of the leading areas of fraud today. And the Association of Certified Financial Examiners reports that approximately 15% of fraud comes from this. So a lot of people are relying on their principals. That's what I got out of that.
Yeah, living large, living large. You know, it's amazing. It's the university, hospital system, that the university didn't have any credit cards for international travel. Of course, we weren't doing much international travel. And I'm going down to Nicaragua and I'm carrying $10,000 in cash in money belt. I'm not kidding. I'm not kidding. And then I get down there and we're going to rent cars. I had to give them 3 credit cards of my own to rent the cars, right? It didn't get done in advance the way it was supposed to. And so finally we got credit cards at Bellarmine. But then they'd make you check the credit card out before you left on your trip. When you came back, you had to give them back the credit card. And I'm thinking, you know, 100 years ago, when I was at Arthur Andersen, I had a credit card when I was 22 years old and I went to work and they gave me a corporate credit card that I carried around with me and I never used unless it was for Arthur Andersen business because I did not want to get fired. I would never use it for something else besides it be unethical, right? Illegal, you're stealing. What is this? These guys have these credit cards and they go use them. Or they, you know, they draw money or they, you know, in advance and spend it on themselves instead of on the business. Or they eat really nice meals and they drink really good alcohol. I like to drink really good alcohol too, and I pay for it myself when I travel. You guys don't pay for it. Why don't you pay for my alcohol, right? Yeah, we have one drink if we go to dinner. That's if we go to dinner with somebody who we're recruiting with. They can have one, we can have one. After that, if they want another drink, I buy it, right? You know, I mean, what are we going to do, right? You know, so it amazes me this happens. But then I found out the reason we had the cards like that is because we had faculty and staff who were using it for personal purchases. Are you kidding me? You know, oh, well, I just borrowed it. Most embezzlers, they don't even know they're embezzlers, do that, right? I just borrowed it. I didn't steal it. I borrowed it. I'm going to put it back, right? But then what if you borrow $10,000? Are you going to put it back or hide it? So this is really an interesting thing that I didn't realize that 15% of employee fraud is expensive. So if your company is like Bellarmine and treats you like you're a thief every time you go travel somewhere, this is why. There are so many thieves in the world that we all get treated like we are.
So you have to like submit the original receipt too. Like you can't take a picture of it or scan it. You have to give them the actual.
The actual original, yes, and that's because people will submit the same receipt over and over. What do we do when we're doing accounts payable in a company? If you ever pay from a copier, you always insist on the original with a real signature. Original with a real signature. What's the problem with that? Everything's electronic. And electronic transfer, so do you have an original? Well, not really. Right? So yeah, I have other concerns. But yeah, that's why. And it drives me crazy. My wife always says, no, I want to keep the original. They can have a copy. And we won't get paid. They get the original. And they keep it. They don't send it back to me. I don't want it. I make copies. We're good.
Any questions?
I thought he was heading for the door.
Oh, shit.
Yeah, this is really an exciting area. Thank you. Exciting area followed by another exciting area. No,
Exciting, though. It's quite the
they're all exciting.
You know.
I should say faculty, staff, and administrators. I let the administrators out of that. People live large.
Somebody just leave. Adam just left.
Yeah.
All right. Well, for those of you that don't know me, my name's Grant.
Is there anybody that doesn't know you?
All right, so I'm going to do the audit of the inventory and warehousing cycle. So
That's a nice thing about this program. It's so damn hard that by the end you all know each other really well.
So I thought that, well, first of all, I thought the intro story, I'm not going to read it, but it was kind of interesting to me at least. And then the opening sentence was actually kind of, it was what do you call it? It caught my eye because it was describing all of the different ways that inventory, or like why inventory is so important to audit. So if you all can see these, in the very first paragraph, all those bullet points, inventory is often the largest account. It's often in different locations. These are all just things that I noticed that I didn't really think about prior to reading the chapter. Diverse inventory items such as jewels, chemicals, electronic parts are often difficult for auditors to observe and value. So just something to keep in mind as we go through these slides. And then just like Adam's chapter, we have a flow of inventory and costs. And actually, I don't even need to talk about it because Keith just took like a couple of minutes describing it.
When I was way back when we were short time there, I was down in Santa Fe and we were doing a national semiconductor audit, and they make all kinds of transistors and diodes and little parts for computers or whatever. And so we were counting transistors and doing an inventory, and they had little dots on them. And the way you could tell them apart was they had little dots on them. Some was blue and some was green and some were whatever. And some of them were worth $1,000 each, and some of them were worth $2. I'm not kidding. And all they had were different colored dots. And the devil gave mine, so we're separating all these colors, making sure the colors are right, And they tried to keep the colors sort of different, but they had a lot of different ones, and that's what all different colors will get. And so they're thinking, geez, if you just mix these up a little bit. And later I was thinking, all somebody have to do if they wanted to pull the wool over the auditor's eyes is just take a little dab of paint the really inexpensive ones with an expensive color and put it in the bin. Immediately, a transistor looks like a transistor looks like a transistor. They just do. It's just you can punch it in the circuit board, right? They just have they do all kinds of different things. So what do you need to do with that kind of environment? And by the way, they were doing some other things besides counting. What do you have to do besides counting? Like circuit board, see if it works. I had a client later on that had diamonds. I don't know about you guys, but I look at a piece of, it looks like they all look like a piece of glass, including this. I don't know how many thousands went on my wife's picture, right? Once I bought her diamond earrings. Did I tell you guys this? I got a chance to do some extra money on the side, and I actually didn't tell her about it because she handles all the money, right? So it goes to her. Everything's on direct deposit to Laura, right? So she's got all the money. So if I ever wanted to buy her a nice gift, right, she'd know instantly because I have to use our joint credit card or ask her for the money or something, And so, anyway, so I wanted to spend a few $1,000s I thought on diamond earrings for her, right? I thought, well, I can't remember. Maybe it was 15. Maybe it was 3,000. I was making off of this deal, right? And so they're giving me $3,000. So I have 3,000 cash for the jeweler. And I said, so, what kind of diamond rings can I get for, or diamond earrings can I get for $3,000? And he started laughing. Right? This is the guy that my wife goes to having to do stuff. And he starts laughing. I said, well, why are you laughing? He says, let me show you. I'll show you how small they are. You can almost not see them. Your wife wants good quality. She doesn't want glass. She wants good quality. Oh, okay, that's nice. So he showed them to me nice and cool. How much? I said, I don't know, 8. Here's what you get for 8,000. I mean, they're not that big. They're not like this. They're a little tinier. To me, it's a rock. Okay, but she's got them. She loves them. She wears them every day of her life. I love her, and so they're worth it, right? They're worth it. Sure they are. Okay, anyway. So here's the deal with that. How would you tell if you were auditing that? I had a client that was a jeweler. They had diamonds that were worth $100,000, and then pieces of glass that looked like diamonds. You know what I mean? Not costume jewelry, but what do they call the stuff? The big ones? Zirconium. Yeah. So zirconium is $200 and the diamond is $8,000. You know what I mean? Same size? I can't tell them apart. What do you do? Bring in specials. There are real opportunities where you use specials, guys. Okay, inventory is a big one for that. Estimating how much you have. If you have a product that's piled up in a field, right, it'd be an interesting task to estimate that. How about your trees that are standing? Estimate that for me. We did a really neat one though on cattle when I was at Central Washington University. I was paid almost nothing. I didn't have a PhD yet, so I made I don't know, at least half my salary, maybe more, maybe almost double, being an outside independent reviewer for a CPA firm. So I'm doing both. And anyway, we had this client that was meat packing and had stock yards, and we had to count all the steers because we had to know how much they were worth. Had an inventory of steers sometimes. What do? Well, you could haul them out, load them up, and weigh them, and you could actually, but are you going to move all of them? There are thousands, right? We're going to move them. Yeah. So this guy I was working with, he was a professor at Belgium and did an auditor at Ernst & Young. He says, I've got an idea. I think this will really work. We hired somebody to do aerial photographs. And they had to be all at once because, these darn steers will move, right? So they took all the pictures from, an airplane all at once. And then we got in the conference room and we took all these pictures and we laid them together. And what we did before that was we went around all the fence posts and we put numbers on the top of the fence posts, right? So we could tell what went where. And we laid the thing all out and we got really pretty close. And even then, and the whole conference room is, it's a third the size of this room, maybe. The whole floor is covered with these pictures, right? It's a big area. So then we had to figure out, well, that's great, but I'm not counting all those still. There's thousands of them. So what we did was we randomly selected areas. So we cordoned it all off into areas, right? Drew lines across it or laid something across it, right? So it was cordoned off into areas and we numbered them all. And then we did a random number, right, selection of which squares we were going to look at. And then inside those squares, we counted very carefully exactly how many steers were in there, right? And then that gave us an estimate of how many steers in total there were. But we still have a problem. How much do they weigh? What do? Because we wanted to know how much meat we had, not how many fed we had. That's other value. What do? You can get in some interesting situations. You have to use your imagination, right, a little bit, and think. So we spend a lot of time thinking about what to do versus doing it, right? We save ourselves an amazing amount of time and them an amazing amount of money by taking the strategy. So then what we did was we went back to their records, and over a period of time we looked what the average steer weighed, right? And we relied upon that. Do you think that's good enough? Because they were loading them, they were bringing them in, and they were feeding them, and they were leaving feedlot, right? They're bringing them in, and they're leaving. We had to decide how long they fit in there and how much they've been fed, because that would change how much they weighed. It's a work in process. So, got it, guys? So does anybody have a good inventory story? I kind of like that one. It's kind of different. Anybody do something fun in inventories?
Inventory?
The shipyard in County Steel that Jeff wrote where they use boats, and so they're just counting sheets of steel in different parts.
Sheets of steel are real expensive, aren't they?
Yeah.
Yeah.
And they're very tall.
How much was each sheet worth? How big was it?
Oh, I didn't get
How many tons? You didn't get into the pricing? You
No.
didn't count?
Yeah.
Car parts at Toyota.
Oh, wow. They have a few car parts over there?
Oh, yeah.
It's been a little bit of time, huh?
Yeah.
But you're doing test counts, remember, you guys. You are not counting for them.
Right.
They count, you do test counts, right? And you don't look at their count, because otherwise you might be biased by it, right? What you do, or you might make sure the number matches theirs. So you do independent test count study, and then later you tie them together. I got another one. You'll like this.
Keith, would you explain what a test count is?
Test count is just they're counting the inventory, right?
Right.
And you at random, hopefully, select which inventory items you're going to count. So that you don't just count what happens to be there. You count, maybe you're going to try to count something that doesn't exist then, right? And then you have the client take you to the one that you randomly selected if you counted,
Okay.
right? And you make sure the number matches up, and then later you match the quantity, right? The part number has to match up. So they're testing, right? And yeah, so you're auditing what they did. And then you observe the inventory too, right? In the inventory observations, you read their instructions, you watch what they do, you might make sure they follow the instructions, make sure they know what they're doing. Actually, it's nice if you read the instructions before they do the counts, you make sure the instructions are right, because you're trying to do that. But let me give you a good one. You'll love this and how bad I screwed up. It's a miracle I didn't get fired. I just transferred from Seattle to San Jose, and I had this senior. I told you about having a senior one time who had not passed the CPA exam yet, and he was a 5-year senior, maybe 6, and they were going to fire him because he wasn't going to make manager. Maybe 7. I think it's 7 years. But they were going to fire him. He did really good work, but he can't pass the CPA exam, so it's a CPA firm, so they were going to let him go. And he knew they were going to let him go. So he either passed the CPA exam and became a manager, or he didn't pass the CPA exam and he got fired. And this happens. And so he just had test anxiety big time. Obviously, he wasn't passing. He knew what he was doing. So anyway, I made the mistake. He asked me. He says, "So how many parts of the CPA exam have you passed?" And I'm a stupid little kid. I'd been working for Arthur about a year in Seattle, and I transferred to San Jose where they were much busier. Yeah. So I smiled. Oh yeah, I passed all 4 parts because I assumed he had the head senior, right? He didn't say a word. So anyway, I'm working for him on the engagement. He didn't tell me what I was supposed to do on an inventory observation, and I had never been on one. And it was unbelievable. I went out to do test counts, and I wrote down all the wrong numbers in my count. I didn't write down their inventory number. I just wrote down some number that was, I guess, on the package or something that I thought was the inventory number. I didn't know how to tell what was the inventory number, I guess. I don't know how I managed it. But anyway, all mine are wrong, right? So then when they're trying to do the tie-in, right, what you're going to try to do is take your test counts and match it to their counts. They can't identify which inventory items I can count. And he just went ballistic, right, really mad. And at one point, he says, "How could you have pass the CPA exam if you don't know anything? If you don't even know that much?" So then what happened was I get into evaluation that I'm just the worst auditor on the face of the earth, right? And usually I got how you guys go, you work hard. Anyway, so I'm in the manager's office. Immediately he calls me. He says, "Okay, I want to talk to you about your evaluation before you see your evaluation." He's got it. And he hands it to me. I'm reading it on these my fire, And he says, "No." So that was when he told me the guy had to pass the CPA exam, or he wasn't the manager. And he says, he's done this to other guys too. He says, "Did you tell him you passed the exam?" He knew what it was. So he put an extra note on it. I still had that evaluation, by the way. And you know what? It was the truth. I had really screwed it up. So here's the deal. Always have the courage to ask questions and keep asking until you get an answer, or refuse to do the work if you don't know how. Now, that doesn't mean that you have to understand everything that you'll be working. How many of you have gone out and the senior's too busy, and the manager's not there, and they say, "Just do what you can get done"? Have you run into this one yet? All the time, huh? So that's okay, but if they never explain it to you, you never get any feedback, ask. And if you have to go above the senior, check out what the manager's like first. Some of them are kind of, "No, I won't talk to a staff person." If you run across those folks, no, good, that's good. Okay. But occasionally you'll get that. But otherwise, it's just fine. It's no big deal. Or ask experienced assistants. They'll show you. They'll help. Everybody's training everybody. Okay. Seeing as we already talked about that.
Yeah, we've already discussed this, so I'm fairly confident everybody knows that chart. So basically, these next few slides kind of just sum up what's in this. They talk about the different processes. So if you can look, and I'll just use the math. So receive raw materials. That's when you debit it into raw materials. You store the raw materials materials wherever they go, and then when you process the goods, that's when you get them in the process, store and finished goods, you put it in finished goods, and then ship it, that's when it becomes.
When you think about custody, those are different people, different warehouses perhaps, right? You might have a raw materials warehouse, right? And then you might do a receiving department of raw materials warehouse. You might have then obviously a factory or a building site if this is construction. You know, and then you might have a finished goods storage area, right? You know, warehouses, and then obviously shipping. FOB destination, FOB shipping point.
Alright, so then it starts getting into the audit of inventory. Real quick, I meant to mention, if you, just in case, because I know I needed this to go back and review, it talks about job cost systems and process cost systems, all that stuff, cost accounting stuff, and it had been a while since I've done any of that, so you may want to go back and read over that. And then it goes into the perpetual inventory master file and explains how that works. It's not too complicated though.
You guys did keep your intermediate book, your cost book, and stuff, tax book.
Cost was online for a lot of us, I think. I know it was for me, yeah. So I don't have
So
that
you
one.
get to keep it.
No.
That's not a good stretch. That's annoying later. I do realize that if you buy them, cost you more, it's online, and then you're going to throw them away when you're done. You can never sell it after you use it up through the CPA exam. But that's a good investment. Now that you're done, I'll tell you that. I told you that principles. Save some money. Yeah, save some money. Yeah.
Yeah.
You can still find books, of course. We have no library, by the way.
So then it gets into parts of the audit inventory, and this is already got, the slide already goes into the detail, but if you look on page 676, it kind of lines it out for you a little bit, where it says the audit of the inventory and warehousing cycle can be divided into 5 activities within the cycle. It's probably a good idea to know these, considering he put the different steps in the acquisition and payment cycle on the last test. I know I didn't get that.
Obvious.
I didn't get it.
Yeah, maybe they're not so obvious when you try to write them down.
Yeah. And then on page, so that's important. Look at those, and then basically, I mean, obviously, y'all know how it goes. It sums it up. It talks about acquiring and recording raw materials, internally transferring assets and costs. Actually, going over these, I thought everything was pretty intuitive except number 2, internally transfer assets and costs. So I made sure to read over that, and because I mean everything else like ship goods and record revenue and costs. That's obviously when you put it into cost of goods sold, take it out of finished goods. And so then page 677 has a nice little chart, and that just sums up everything that I just said. So really, all you need to do is look at this chart. You don't need to read the chapter. But seriously though, it said, receive raw materials. I don't know if they have that in the slides or not. I don't think they do. No, they don't. Okay. So, but you all can see that. Everybody has a link in here where it says receive raw materials. That's you're receiving the report, your vendor's invoice, and then you put materials in storage. Then you're going to be using the raw materials perpetual inventory master file. Put materials in production, so that's your raw materials requisition and your cost accounting records. So then when you put completed goods in storage, you have your finished goods perpetual inventory master file as well, and then again your cost accounting records. So a lot of this does have to do with cost accounting. Everything that gets recorded pretty much, which makes sense.
You want all these things. Why do you want a purchase requisition separate from purchase order? I think it's better internal control if you use a purchase requisition and a purchase order than if you just use a purchase order. Small companies would just put purchase order differently. But if you got enough personnel and you have enough transactions going through, why would it be better? What did you get?
2 sources.
What's that?
2 sources. Higher quality.
2 sources of authorization, right? Who does a purchase requisition? The people who are going to use the goods you are purchasing, right? Or if you're building inventory, it might be the engineers that specify what you need, right? And what parts are, and how many you need, and all that stuff. It could be, right? And then who's gonna do the purchase order? Separate purchasing department, they never touch the goods, right? They're not gonna use the goods, they don't even know what they're for, they don't care particularly, right? They know what the goods are, and they know what the price should be, and they know who you should buy from. So that's their job, and you think you did better control that way? You know, and then the receiving report. Do you want the purchasing people to be receiving? No, probably not. You want a separate receiving department doing it. By the way, you want your shipping and receiving to be the same people. Not if you can help it. But in a smaller organization, of course, it's the same people. You got one loading dock, right? One receiving. And then otherwise, you keep them separate, wouldn't you? Okay? Less opportunity for collusion, sort of thing. Okay? So,
Yeah.
so you can think about what's that?
Why would shipping and receiving matter be separate?
If you want to, conceivably people could have things delivered that they then took.
So why does that matter if they're shipping?
Well, if they have the ability, it allows for easier embezzlement with less collusion. So if you could get somebody to buy it, right, you know, and record the purchase and record the sale, and then you're handling the goods. So if the goods come into you, you could give them to you, right? Versus you got to get more people involved, right? If it comes in and it goes through warehousing, it ends up in the warehouse, getting it back out to you is more difficult. Does that make any sense? It just allows easier
more
collusion.
separating receiving and warehousing from receiving and shipping though?
You want those separate too. But if receiving and shipping are together, you never have to go into the warehouse if you don't want it. You can just receive it and
Ship it back out.
give it and ship it back to yourself, right? It never runs through the warehouse. Of course, that, and I still say collusion because what we just still have to have. Somebody's got to buy the pay for those goods. It doesn't do any good otherwise. So you have to have somebody do the purchase, they record that, run the payment through. Although you can still have good internal control, the payment works fine, right? So you need somebody that was doing the purchase in cahoots with the people who were doing the receiving and shipping. That's two people could probably pull it off with good controls otherwise. So you separate as many things as you can, really, when you get down to it. Could your raw material storage and your finished goods storage be together? Of course it could. But is it better separate? Yeah, probably. Yeah. Same rule of thumb. Okay? Same.
Alright, so moving on, it's a lot of these the slides, I was going over them yesterday, and a lot of them kind of just break down this process. I mean, it's all really repetitive though. So you got part of the audit in this one. So you're shipping the goods, and then you record your revenue and costs. And then so the auditor is going to come in and physically observe your inventory to make sure that it exists, it's reported at the correct price. And then you've got this key component called pricing and compiling inventory. There are these things called inventory compilation tests, and basically they're used to determine whether the physical counts were correctly summarized, inventory quantities and prices are correctly extended, and the extended inventory correctly footed to the equal general ledger inventory balance. And I'm just reading that off of 677 if you all want to see it. Yeah. Alright, so then they really stress cost accounting controls in this chapter.
You know, that last one really points out how this is not a whole bunch of different cycles. Do you really think these are separate cycles, or is it just one continuous cycle? You buy stuff and sell it, or you manufacture stuff and sell it, right? I mean, it's just one big thing. It's all connected. So we arbitrarily break into cycles so it's manageable for audit. You can't separate inventory from cost of goods sold out. You can't separate cost of goods sold from sales. And you can't separate sales commissions from sales. You know, you just can't. And so all this stuff starts coming together. So you just arbitrarily cut it. So what they're saying is, well, yeah, the shipping the goods and recording revenue, cost of goods sold happen in the sales and collection cycle. Well, that's really part of inventory, of course, right? Because, you know, inventory is beginning inventory plus purchases, less cost of goods sold is ending, and you're doing cost of goods sold while you're doing the sales and collection. So it's arbitrary. Does that make sense, guys? So different auditing firms will set it up differently. You know, whatever they're comfortable with. And different size clients will be different, right? Did you know? Anybody notice that? Big clients or little clients? The little ones all one big audit. The big ones, they really partition it because there's so many transactions at so many dollars. right? So many things going on.
Well, just gonna say, I think it's because of that the book seems so repetitive because they're trying to break everything up, but then they have to take all this extra time to explain, hey, this is related to this from the last chapter, you know.
And trying to see the connections.
Yeah.
I'd hate to write an audiobook. I mean, yeah, I'm sympathetic. This one's pretty short, believe it or not. Yeah.
So, as I was saying, so they really stress these cost accounting controls in this chapter, which makes sense. They want to make you want to make sure that all of your inventory, all of the client's inventory exists, and that it's all recorded at the correct amount, which actually ties into if you look at page 679, when it really introduces these controls, it says that it's convenient to divide them into two kind of umbrella categories. The first being physical controls over raw materials, work in process, and finished goods. So that's making sure everything exists. And then number two, controls are over the related costs. So you want to make sure everything is accurately recorded. And then posting and summarization, everything gets posted into the corresponding accounts correctly.
And what are they segregating?
They're, the authorization.
Custody, record keeping, you go down the list there, and monitoring activity, right? Over and over and over. And really big in this area, right? You care about where that inventory is and controlling that inventory. People usually think, well, finished goods inventory could be stolen or could be sold to somebody, but there have been some interesting frauds where people sold raw materials because the controls weren't very good over it because nobody thought they'd see it. They'd sell steel bars, right? Steel plates if you're looking at, right? Sheets of steel. How would anybody do that? Well, you just pretend that you're a steel supplier, and you've got steel and you just sell it, right? And you don't have good controls to prevent it physically leaving, right? And the record keeping related to that. So we keep those things separate, that's all. This area in particular. Lots of opportunity for, by the way, are there a lot of opportunities here for misstating your financial statements? How easy would it be for Ford to make their inventory smaller or larger in work in process? Oh, man. Oh, man. Try a lot of it.
You've all seen this slide before. Just this name right here changes every time. You all know this.
Maybe I'll just have a question. We could draw that slide. What do you think?
Put in any account that we want to.
Yeah, pick an account.
So then you got, so then it goes into test and cost accounting, your physical controls, documents and records for transferring inventory, perpetual inventory master files and unit cost records. The third one's interesting, perpetual inventory master files. It said this is important to pay, well, everything's important to pay attention to, but pay special attention to this because in your perpetual inventory master file, it is what it is in the name. It's perpetually going, so it's like real-time recording, I guess, but a lot of companies don't keep work in process included in it, so you have to pay special. It said something about being able to tie this out to the work in process account because you're recording everything constantly, but then you have to do your work in process, I guess, by hand or on the computer, not using the audit program or the client's accounting system.
It's the same thing when you can audit around the system, you can audit through the system.
Right.
Right, guys? Same things we did when we talked about systems.
And then something that I thought was interesting, on page 681, if you all look at the box on there where it says cost of coffee, this example was kind of interesting to me. They kind of shed light on how easy it is for companies, like what Keith was just saying, how easy it is to misstate your financial statements using your inventory. I also thought it was interesting because this is somewhat of a relevant company. I don't know if you all are familiar with Green Mountain, but I think my mom's pretty sure they're still around because I was at home the other day and she had Green Mountain K-Cups there.
Well, there may be somebody bought them.
Or, yeah.
The brand's still around.
Because it was back in 2010. I was like, I know I've definitely had their coffee after 2010. So that was interesting. I'll just take a minute to read it.
You guys have heard of Crazy Eddie, have you? And
Is that the guy?
it's on case, but that's a different one. Since then, one of the company's critics is former criminal Sam Antar about orchestrate inventory fraud, Crazy Eddie's. Yeah, it's real interesting. You've seen videos on that, used videos on that. Famous fraud.
So then it goes into it goes into the analytical procedures that you can use when auditing inventory, and it actually has all these listed on page 682 in table 21-1, and it kind of just it's basically this exact same slide, and this one and this one. Yeah. So you all can look at that.
These are pretty good though, you know, gross margin or cost of goods sold percentage, either one, right? Maybe the same thing. It might tell you that there's a problem, right, with one account or both. You know, it should make sense. Inventory turnover changing, well, you know, or different than you expect. It's the main thing. You know, all these are analytical procedures, of course, right? Unit costs of one year to another. You know, does that make sense? Maybe they overinflated the cost per unit, even though the count's right. Right? They got the cost too high, pulled it up that way, but maybe it's just price increases too, right? Okay, cost increases. Right? Extended inventory value without a previous year, sure, just a total. Okay, so a whole variety of ways, right? Variable cost should be adjusted for changes in volume. Okay.
All right, so then it goes into the audit responsibilities for client physical counts. So obviously, you want to be present at the time the client counts inventory, observe their accounting procedures, ask the client, say, ask them about why they're doing this procedure, or why the company might implement a certain procedure, and then make your own independent tests of this business. So you also want to do it yourself. It talks about inventory price tests, which are just all the tests of the client's unit prices to determine whether they are correct. So
What would you trace those to?
uh,
They've got the quantity on their inventory sheet, right? You know, they got the cost on the inventory sheet. What are you going to trace the cost to? They're probably purchase orders, yeah. But then you want to make sure it's a lower cost or market, so now what do you do? What do you need to know? Market. You need to know estimates of market, right? What are the estimates of market? Net realizable value, which is what? Sales price less disposal cost, right, guys? Okay? And then you want what? Net realizable value less normal profits. You need to estimate that. See, you're going to want to look at what their procedures are, how they did it, and you're going to want to do it yourself on the ones that you're testing, right? Okay? And then what else do you need? Replacement cost, right? Has the cost changed substantially? You take the one that's in the middle, remember all that nonsense? Right? You take the one that's in the middle and you compare it to cost, and then you make sure they're lower cost or market. And you do that at the same time that you're checking their costing, wouldn't you? Because do they have the right cost? So all wrapped together into one. So on a sample basis, you're doing a test of how they costed it out. Okay?
So then it goes into each one of these
Yeah.
up here. So you all can read supervision by responsible personnel. It all makes sense if you think about it, but
there's a lot.
Yeah, there's a lot exactly. So then you got your audit decisions. So these are all three crucial items in your audit decisions. Well, really all the time, but especially during inventory, your timing, sample size, and selection of the items.
How do you decide whether or not you do this in an interim, in terms of time? Interim or year?
Control.
How good are the controls? That's it. Because what do you have to do if you do it in interim? I count a default to the inventory at the end of every month, huh? So let's say my year ends December 31st. January 31st, I count inventory. What do I have to do with that inventory, that 1/12 of the inventory I counted, to get to year end? Roll it forward, which means add all the purchases for 11 months, right? And take out all the cost of goods sold for 11 months, and I get the ending inventory at the end of the year. How can I rely on that number? Their internal controls are fantastic over purchases and recording cost of goods sold, right? For sales, they have to have both sides good, don't they? You record the cost of goods sold and sales first, okay? definition, the controls aren't as good if they don't have a perpetual inventory system. You have a rough time, aren't you? How would you get the cost of goods sold? Well, you can estimate it, sure. You can. Sales, cost of goods sold percentage types of sales. You could, sure. But boy, that's not going to come out very close. Okay.
Okay, so physical observation test. It says the most important part of the observation of inventory is determining whether the physical count is being taken according to the final instructions. So meaning you're going to want to follow the same procedures that their company establishes for counting the inventory. That way you can have a similar answer. So if you use different procedures for counting their inventory, then you're never going to come out with the same answer. All right, and balance-related objectives. You all can read this. And I've already stressed two of those. Existence and accuracy. That's completeness. And
That one question that I gave you where I asked you for these types of things in an example, look at those. Look how simple they are. Existence. Inventory as recorded on tags exists. Completeness. Existing inventory is counted in tags. Okay.
Oh. Let's see. I know class is over right now. I'm just
I burned it.
it's okay. But we were just about done.
I've got one more that I want to tell you guys. We had this, did I tell you about the student that we had here who now is very, very successful, selling little